History isn't repeating, it's accelerating toward a cliff. In 1720, the South Sea bubble destroyed empires with nothing but hot air and empty promises. Today, we've replaced those worthless shares with phantom carbon credits and ghost forests that don't exist. By the end of 2026, this multi-billion-dollar illusion is going to shatter. The carbon credit market has exploded to over $200 billion, but it's built on fraud. Ghost forests that already burned are generating credits. The same offsets are being traded back and forth to inflate valuations. Corporations are holding worthless green assets on their balance sheets. This is the South Sea bubble with environmental packaging. But before I reveal which carbon registries are collapsing right now and exactly how this fraud works, let me show you the 3 mechanisms of circular fraud that make the 1720 crash look small. Welcome to Financial History Decoded, where we study financial disasters to protect you from repeating them. I am going to show you why the carbon credit market in 2026 is an exact replica of the South Sea bubble of 1720, the greatest financial fraud in British history. And I am going to prove it with current data showing that the carbon credit infrastructure is collapsing right now in real time, destroying billions in corporate wealth and exposing systematic fraud that makes Enron look honest. History doesn't repeat exactly, but it rhymes perfectly, and the carbon credit bubble is rhyming with 1720. Let me start with the historical parallel you need to understand. In 1720, the South Sea Company was granted a monopoly by the British government to trade with South America. The company's stock price was driven not by actual trade or profits, but by speculation and hype. The narrative was that South American trade would generate unlimited wealth. Investors, including members of parliament who were bribed with stock, poured money into South Sea Company shares. The stock price went from £128 in January 1720 to over £1,000 by August, an 800% gain in 8 months. But here's the key. There was no underlying business. The South Sea Company barely traded anything. The valuation was pure speculation. When reality hit in September 1720, the stock crashed 90% in weeks. Fortunes evaporated. Suicides followed. The British economy was devastated. Isaac Newton lost £20,000, equivalent to millions today, and famously said, "I can calculate the motion of heavenly bodies, but not the madness of people." Now, let's look at carbon credits in 2026. The carbon credit market has exploded from $50 billion in 2022 over $200 billion today. The narrative driving this growth is that companies can achieve net zero emissions by purchasing carbon offsets. Plant a forest, capture the carbon, sell credits to corporations who need to offset their emissions. The credits are traded on digital exchanges. They're verified by third-party auditors. They're backed by satellite imagery, showing the forests exist. It's a perfect system, except for one problem. Most of it is fraud. The forests don't exist, or they already burned, or they were never additional plantings. The credits are being double-counted, wash-traded, and used to inflate corporate balance sheets with phantom assets. And in 2026, the fraud is being exposed. The market is collapsing, and corporations holding billions in worthless carbon credits are facing a South Sea bubble moment. Let me break down the 3 mechanisms of fraud. Mechanism number 1, ghost forests. A carbon credit represents 1 metric ton of CO2 removed from the atmosphere. To generate credits, you need to plant trees, preserve existing forests, or capture carbon through technology. But here's what actually happened. Project developers would claim to plant forests in remote areas of Brazil, Indonesia, or Africa. They'd submit documentation showing trees planted. Third-party verifiers, often paid by the developers, would approve the project's satellite imagery, manipulated or showing incorrect coordinates, would confirm the forests existed. Credits would be issued and sold to corporations. But the forests were fake. In some cases, the land was already forested, so there was no additional carbon capture. In other cases, the trees were planted but died within months. In the worst cases, the forests never existed at all. The coordinates pointed to barren land or land that had burned years ago. These are ghost forests, and they're generating real credits being traded for real money. Bloomberg investigated carbon credit projects in 2024 and found that 30% of verified forest projects showed no evidence of additional tree planting when examined with independent satellite data. That's 30% fraud rate in verified projects. A 2026 investigation by the Financial Times found that over 15 million carbon credits tied to Amazon rainforest projects were linked to land that had burned in wildfires between 2021 and 2025. 15 million credits. At current prices of around $12 per credit, that's $180 million in fraudulent assets. And these credits are sitting on corporate balance sheets as green assets used to claim net zero status. Mechanism number 2. Wash trading and circular valuation. In financial markets, wash trading is illegal. It's when you sell an asset to yourself or a related party to create the appearance of trading volume and price support. In the carbon credit market, this is rampant. Here's how it works. A project developer creates carbon credits. They sell credits to a shell company they control. That shell company trades the credits back and forth with other shell companies, each trade at a slightly higher price. This creates the appearance of a liquid market with rising prices. The developer then sells credits to a corporation at the inflated price. The corporation books the credits on its balance sheet at the wash-traded price. Everyone reports higher valuations, but there's no real value, just circular fraud. AI-driven verification tools were supposed to prevent this. Blockchain ledgers were supposed to create transparency. Instead, shell companies bypassed verification by using fake documentation and bribed auditors. The AI tools flagged anomalies, but humans overrode the warnings. The blockchain ledgers recorded fraudulent trades as if they were legitimate. Technology didn't prevent fraud. It just made fraud more sophisticated. A 2026 forensic analysis by a major accounting firm found that over $20 billion in carbon credit trades showed patterns consistent with wash trading. The same vintage offsets, credits generated from the same projects in the same years, being traded back and forth between related entities at escalating prices. This is exactly how the South Sea Company manipulated its stock price in 1720. Create artificial demand through circular trading. Inflate the price. Sell to real buyers at the peak. Collapse when the circle breaks. Mechanism number 3. Double counting and regulatory failure. The carbon credit system depends on one fundamental rule. A credit can only be counted once. If a company plants a forest and generates 1 million carbon credits, those credits can only be sold and retired once. But regulatory failures and loopholes allowed systematic double counting. Here's the most common scheme. A project developer plants a forest and claims carbon credits. They sell those credits to Corporation A. Corporation A retires the credits and claims net zero emissions. But the project developer also claims the same carbon sequestration toward their own sustainability targets. So the same forest, the same carbon capture is being counted twice. Once by the buyer, once by the seller. Both entities report reduced emissions, but the atmosphere only saw 1 ton of CO2 removed, not 2. This was supposed to be prevented by registry systems that track credit creation and retirement, but the registries were fragmented. Over 30 different carbon registries operate globally with limited coordination. A project developer could register the same project in multiple registries, generate credits in each, and sell them separately. No one was cross-checked. The rating agencies and auditors hired to verify carbon credit portfolios failed catastrophically. They relied on documentation provided by project developers without independent verification. They didn't use satellite imagery to confirm forests existed. They didn't check if credits were double counted across registries. It was the same failure that allowed Enron to hide debt or Lehman Brothers to manipulate balance sheets before 2008. Auditors do UNT prevent fraud. They legitimize it. Now let's talk about the 2026 flashpoint. That's exposing all of this fraud. In early 2026, several major events triggered a liquidity crisis in carbon credit markets. First, The top three carbon registries, which handle over 60% of global credit issuance, were found to have systematic verification failures. Independent investigators using satellite imagery discovered that 30 to 40% of projects in these registries showed no evidence of carbon sequestration. Ghost forests. Second, a major corporation holding over $500 million in carbon credits on its balance sheet tried to sell them to raise cash and discovered there were no buyers. The market for carbon offsets had frozen because buyers didn't trust the credits were real. Third, margin calls. Corporations that had borrowed against their carbon credit holdings, treating them like collateral, were forced to liquidate when lenders demanded real assets. But when they tried to sell, prices collapsed. Credits that were trading at $12 fell to $3, then to $1, then couldn't be sold at any price. This is the 2026 margin call trigger, creating a domino effect. Corporations are dumping carbon credits. Registries are suspending trading. Banks are writing down billions in green portfolio losses. And the panic selling looks identical to the South Sea bubble collapse in September 1720, when investors realized the stock was worthless and everyone tried to sell simultaneously. There's no buyer of last resort for carbon credits. The government won't bail out fraud. So the market is collapsing into nothingness. The contagion is spreading beyond carbon markets. Fintech companies that built platforms for carbon credit trading are facing bankruptcy. Banks that financed carbon credit projects are sitting on non-performing loans. ESG funds that loaded up on green assets are down 30 to 50% year-to-date as their carbon holdings evaporated. This is connecting to the broader financial system the same way sub-mortgages spread through the banking system in 2008. What looked like a small, isolated market of carbon credits is revealing systemic risk because corporations, banks, and investment funds all held these assets and counted them as real wealth. Let me show you the aftermath that's unfolding right now. First, the immediate shift toward tangible assets. Corporations are abandoning ledger-based carbon credits and pivoting to direct capture technology. Instead of buying credits from ghost forests, they're investing in carbon capture machines that physically remove CO2 from the air. These are real, verifiable, measurable. You can see the equipment. You can measure the output. It's not a ledger entry subject to fraud. Second, the collapse of corporate net zero. Hundreds of corporations publicly committed to achieving net zero emissions by 2030 or 2040. Those pledges were based on purchasing carbon offsets to neutralize emissions. But if the carbon credits are worthless, the pledges are lies. We're seeing corporations quietly abandon net zero targets or admit they can't be achieved without fraudulent accounting. Third, litigation. Class action lawsuits are being filed against carbon credit registries, project developers, and auditors for fraud. Corporations that bought worthless credits are suing sellers. Investors and ESG funds are suing fund managers for negligent due diligence. This litigation will drag on for years and destroy what remains of the carbon credit infrastructure. The survival strategy for investors is simple. Distinguish between real environmental assets and speculative ledger entries. Real environmental restoration involves physical infrastructure. Tree planting projects you can verify with independent satellite imagery. Carbon capture facilities you can inspect. Renewable energy projects generating measurable electricity. These have real value. Speculative ledger entries, digital carbon credits traded on exchanges with opaque verification, should be treated as worthless until proven otherwise. The burden of proof is on the seller to demonstrate the credit is real, additional, permanent, and not double. If they can't provide ironclad verification, walk away. The historical lesson from the South Sea bubble is that speculative mania is driven by narrative, instead of fundamentals, always end in collapse. In 1720, it was the dream of South American trade wealth. In 2026, it's the dream of carbon neutrality through ledger accounting. Both were built on fraud, maintained by corrupt intermediaries, and collapsed when reality couldn't be hidden anymore. The mathematics of the carbon credit bubble are identical to 1720. Phantom assets, circular trading to inflate valuations, regulatory capture, and eventually total collapse. The bottom line is this. The carbon credit market in 2026 is experiencing a South Sea bubble moment. Ghost forests that don't exist generated billions in fraudulent credits. Wash trading, inflated valuations through circular fraud. Double counting allowed the same carbon reduction to be claimed multiple times. Regulatory failure and auditor corruption prevented detection. And now the liquidity crisis is forcing corporations to discover their green assets are worthless. This is financial history repeating with environmental branding. Don't hold carbon credits. Don't trust corporate net zero pledges based on offset purchases. Don't invest in ESG funds heavy in carbon credit exposure. The bubble has popped. The contagion is spreading. Protect your wealth by learning from 1720. Subscribe for weekly analysis connecting financial history to current crises. Share this with anyone holding carbon credits or ESG investments. Comment: if your company is exposed to this fraud, history doesn't repeat exactly, but it rhymes. And the carbon credit bubble is rhyming perfectly with the South Sea disaster. Stay informed. Stay protected.